We've got some fresh new young talent doing some things that I know you haven't heard before.
1, 2, 3, listen.
Welcome to Finances, your home for all things financial, investment, money and lifestyle. Hosted and curated by the very talented team of certified financial planners, Burke Britton Financial Partners. This is episode number 87 of the Finances podcast. This is a back-to-back one. We're jumping straight into another episode because we've got Amiee, practice manager extraordinaire. We wanted to talk, you actually raised this topic, maybe Ben suggested, and you went, yes, let's talk about that. And it was potential reduction in interest rates from the current highs where they are at the moment, and what preparation people should be making to take advantage of that reduction. Now, Amiee, why is this topical to you? Let's start.
Say, Ben will know why I want to talk about it, because it's topical to me and a lot of my friends in this position around this age.
Okay, so explain to me what are you thinking about you? So obviously you're not a financial advisor, you're a practice manager, but you're also, you're a client of this business, and you've got a mortgage. I hope that's okay to say that. And you've been impacted by interest rates positively and also negatively. Do you want to talk about your experience, if you don't mind?
Yeah, I think I'm okay talking about it. So I was lucky enough to be one of the people that locked in a really low interest rate quite a while ago.
Did your advisor tell you to do that, or did you just wing it? Ben?
It did.
At that time, we didn't realise, obviously, that locking in a low interest rate would be so good.
Do you mind me asking what you locked it in at?
1.99.
Yep. Is it still sitting at a fixed rate?
It's still at fixed till February next year.
Holy dooly.
So it was a 3-year fixed rate.
If you could have wanted to do anything with your interest rates and lock it in, what Amy's done at not your direction, Ben? No. Well, you can claim.
I gave her a wink and a nudge. That's a good idea.
You've nailed it, but a lot of people haven't nailed it. But the other thing that's coming for you is the
cliff.
The cliff, yeah. The cliff, the rise, even if interest rates come down, there's still a jump. So there's probably two parts of this. There's the part of the very small proportion of people that are in Amy's boat that were very fortunate to have locked in at low rates and are expecting a massive jump at some point. And then there's the people that have suffered from the variable rate rise and are anticipating some reductions. There's some suggestion that maybe a couple of rate reductions this year, maybe.
Yeah,
what do you
no
reckon?
one likes to, again, you're sort of throwing darts at the dartboard a little bit. But I think, again, we get research from all different corners of, the economist world. I think late this year probably seems to be somewhat of a consensus. Some people are a bit more, buoyant around a July, August sort of time frame. I probably lean towards October, November, but that's just being a little bit of a pessimist. I think the key is that we feel like we're probably at the top of that cycle, so we've probably reached the peak, and now we're going to be in a bit of a holding pattern unless something alters drastically in the economy. So now we're in the hold pattern. It's sort of, for me, I think it's like time to start looking ahead again and start to get organised for what that is. So again, you've got people who are still in fixed rates, and always there's people progressively rolling out probably every day of the week at the moment, still coming out of that, and then trying to reposition themselves for, all right, what do I do now? Probably what I would say is you've sort of just got to ride that variable rate for a little while here and get some clarity.
So are you assuming this is a person that's already on a variable rate that's copying the elevated rates right now?
Yeah, or they're just rolling it, about to come out of fixed too. Anyone who's sort of in that about to be or is currently in there, you probably, and again, this is where fixed rates are dangerous generally. Like, people have benefited from fixed rates in the last, let's call it 5, 6, 7 years, but prior to that, you were fixing at a higher rate for the stability. You were paying a premium for stability.
Cash flow consistency.
Yeah. You weren't trying to play the game of will they go up or down. Like, rarely was that actually the case. For a lot of people, they've pretty much only owned a home or had a mortgage in a period where fixed rates were super low. And people are living in this sort of fantasy that will occur again. Like, it's unlikely. Like, if we project forward and you say, right, we're just sitting at a variable rates, on a home loan, it's 4.5%. You're probably going to be paying 4.7, 4.8 for a fixed rate to lock in and pay for certainty. People are still trying to think that, it'll go all the way back down again. We're probably never ever going to see interest rates at that level that they were at when people were able to fix them at that period of time. So we've got to be realistic about our expectations of what that is over the next 6, 12, 20 years, realistically. So how do you position yourself for that? You've got to have options.
Can I ask a question of you, Amiee? Practically, what have you been doing given that you winged it and you got your rate locked in until February, what have you been doing over the course of these last few years, knowing that you're on a very, very low rate relative to what the variable rate is? And what have you got planned for the rate cliff that's coming?
Well, I went to Europe, so that probably wasn't on the list as part of the plan, but I've started to, I guess, squirrel away a bit of a buffer. So I've spoken to a few close, helpful people that haven't given me any advice specifically, but to have that buffer in place before February next year is going to be really important for me because I don't know what the rates will be this time next year. So it's a little bit of the unknown, but it's also known that it's definitely not going to be 1.99.
I don't want to answer this for you, but maybe, running a few projections on what will that be as a monthly outlay if rates were at, hypothetically they come out and you're at 6 or they're at 6.5, or if they were to be at 5, and trying to sort of benchmark and have an idea of, okay, that's what it would be, that's what it would be, that's what it would be, and start to sort of mold that position progressively and know that I can deal with that. For some people, they'll do those numbers, maybe they've already done them, that they just can't make it work. Like, it just doesn't functionally work for them. And that's where you become a distressed seller, or something in their life has to change. They've got to generate more income, cut their expenses, or sell their house.
So maybe
That's
a quick
last
question.
resort.
Yeah, sorry to interrupt. When you said people need to ride out the variable rates at the moment, what should they be doing to ride it out?
I think that
Is it getting a second job? Is it getting a renter in? Is it selling the house and getting what you can?
Yeah, it depends. And I think they're the options you got simple, and we always talk about this, the really simple thing is you've got your current situation, you can increase your income, which is, you work overtime, you take a second job, those sort of things.
Well, can I just say before that the option of actually reviewing your existing arrangement, right, is, maybe you're getting there, sorry to cut you off, but reviewing your existing arrangement and working out whether or not, even though the rates are still high, whether there's another provider that you can get potentially a better rate. However, a lot of people, because of the rate rise, are in what we call mortgage prison, and they can't actually refinance. So they are literally stuck with what they have. And so then you've got to look at the other avenues of, can I increase revenue from some other source? And are there other expenses that I can reduce? And again, there's diminishing returns with both of those, because you've only got so much time in the day to actually, work time for money. And there's only so far you can cut your expenses, and you get down to the bare bones, your non-discretionary expenses. A lot of people, that's what they've done. There's no more room to cut. So in those instances, that's probably back to the last episode we talked about, where you see a lot of people actually leaning on family members and saying, hey, I need some support. I can't get it from the bank. I can't work anymore. You're seeing people lean on family members, older family members with some wealth to actually help support them with their properties.
Yeah. And even back to that sort of riding the variable rate, like, that means you don't go and tie yourself into an arrangement at this point. Like, don't try and fix something, or like, negotiate with your bank. So if you're in mortgage prison, which we've done a podcast about, where you're sort of unable to actually move because of your serviceability, talk to them and push them for a better rate. Most of the time they'll give you something. It might not be a lot, but they'll give you something. If it's really, really, hard times, you might be able to go onto an interest only or on a pause. But again, that's where we probably need to be seeking some serious advice around what's the viability of this long term. Something's probably not quite right there. So as we sort of roll through this year and we get ready for that drop, you want to be knowing where you stand and being ready for that. So a lot of people maybe now been able to build into their cash flow that they can afford it. So they thought they couldn't. They'd rejig some stuff, expenses. Maybe I don't know how many people have reviewed their home and contents insurance, their health provider, all those things that they hadn't done for a decade because they realized they had to. So now they've sort of functionally created a bit of surplus, which has then been used for that mortgage through the last couple of years. Now that as that comes out the back end, what do they do? Do they then reclaim that cash flow as rates come down and they spend it? Do they go on the holiday they've been deferring? Do they continue to push it towards their mortgage and actually now go, right, well, sort of learnt the hard way, that can get tough quickly, let's take a chunk out of it? Or do they invest with that surplus? It's going to be different for every single person. I think that's where the good thing is, this won't happen quickly. We probably talked about rates not going up quickly, and they went up rapidly, but it's still progressive. You've still got a month between each rise. You've got time to continue to recalibrate. as rates start to come down, it's probably going to be progressive as well, but you need to get ahead of that. Start thinking about, start projecting forward and going, okay, if rates did drop by this, then that means this. And then start to plan what that new cash flow, again, newfound, maybe reclaimed cash flow, has the biggest impact for you. Maybe some people need to take some of that back into their living, like they've gone without, and that's not what we want. Like our whole preface is to try and continue to live, but also look at the future. So trying to balance that up is where we are in now, for me and my mindset around those clients over the next 6, 12, 18 months.
Yeah, and even though every client situation is different, I think the common thread with all of them is cash flow and getting, so whether cash flow has been super good for you and you're preparing for the fact that it could be worse, or cash flow has been dog shit for you and you're trying to find ways to improve it, getting a handle on your cash flow. Well, again, I do get sick of hearing myself say this all the time, but cash flow is the cornerstone for any decision you make in your life, financial or lifestyle. So if you can get good at actually managing cash flow, money in, money out, then you can make decisions about where it goes. Where do you place it? Do you put it in investments? Do you go to Europe? Do you pay extra principal off your home? Do you set up education funds for your kids? Do you make concessional contributions to super? The list is endless, and that's I suppose the exciting part about financial planning when people have their cash flow under control is that they have so many levers to pull, and gone then are the worries and concerns about, shit, I can't pay my mortgage, or what's going to happen in February when rates go through the roof. You're excited about, hey, I've got a surplus and my decisions are, what do I do with it? Like what do I actually do with it? And that's what we're trying to work towards for all clients, is that they're not living paycheck to paycheck, that they've actually got surplus that we can help support them. And again, everyone's different. People come to us with plenty of cash flow and lots of options. Some come to us with challenges around finding the structure of their debt and their investments from the baseline. But all in all, you've got to get your cash flow under control to be able to make those decisions.
Yeah, I think quality of life is something that Ben and I spoke about a lot earlier this year. You don't want to have to compromise on the things you're maybe used to doing or like doing, but it's about balancing that with your cash flow and making sure it works for you long term, not just,
because
I want to go out for tea 4 times this week because I like going out for tea. It's a balance.
Some people have no result, like they just do it, like they absolutely no restraint on themselves.
Yeah, they say, I should be able to live the life I want to live. Yeah, but at the cost of, a credit card that grows that they can't pay off. Again, you got to take some level of, well, not some level, you got to take personal responsibility with that. And yeah, there's a balance. Like sometimes you can't do everything you want to do, and sometimes you got to make some hard decisions. And sometimes you got to work harder or go and seek advice to make better decisions so you can have the deferred reward of having income later. Yeah,
I think this one, as we roll through the year, is probably going to be one of those things we continue to loop back on as we get more guidance, more idea of what it looks like, and start to see what the banks do with rates and stuff too. So I think we'll probably talk about this multiple times throughout the year, which will be interesting to see.
Yep,
how it unfolds.
Anything else, Amiee? Any other concerns about your interest rate and your mortgage before we let you go and manage the practice?
No, I'll just keep running my questions past Ben and Jay. It seems to work pretty well.
All right, awesome. All right, guys, thanks again. We'll see you next week. Bye.
Thanks.
We hope you enjoyed today's episode. If you're keen to understand more about how financial advice could benefit you, follow us on Instagram, Facebook, and Twitter at Burke Britton FP, or Google Burke Britton Financial Partners. Check out our client reviews, testimonials, and make a time to meet one of our certified financial planners by clicking Book Now on our website. Thanks for listening.
Any information contained in this podcast is of a general nature only. No account was taken as to the objectives, financial situation, or needs of any particular person. Therefore, before making any decision, listeners should consider the appropriateness of any information with regard to their particular objective, financial situation, needs, and seek independent advice from a licensed professional specific to their circumstances.
All right, hit it.
That translates to, don't be a moron and act on what some random person says on a podcast. Take personal responsibility, do your homework, ask questions, and speak to an actual human that knows what they're talking about before you do anything. PB Financial Solutions Proprietary Limited, trading as Burke Britton Financial Partners, are authorised representatives of AMP Financial Planning Limited, AFS licence number 232706.